Hi, I'm Keith McCullough, and welcome to another Real Conversation. An exciting time for the topic that James Davolos is certainly one of the people that you'd want to know from, you'd certainly want to hear from, and full disclosure, I do own, James, I do own your ETF, so the INFL, which a lot of our subscribers, I know they own it as well. It's the Inflation Beneficiaries ETF, and you guys have done a great job just, again, putting it on the shelf right on time, really, in an environment like this where I quite frankly think that not a lot of people actually understand inflation, but they do have a lot of opinions on it, which makes for an interesting market debate. So first, welcome and thanks for taking the time.
Yeah, thanks so much for having me, and delighted to hear that you're a holder as well as a lot of your subscribers.
Yeah, I mean, the first time we had it was you, I, and Murray on a three-way, and I told you guys, I said, look, this looks really interesting. I want to have this conversation because if I'm going to buy it, I want to understand what I own, or at least attempt to. So, shortly thereafter, I bought it, and I buy it on every damn dip. And I particularly like to buy it when people say that inflation is transitory, James. Now, to me, we've been bullish on inflation since June of last year. So inflation is trending in real return terms, so trending as opposed to transient. And I wonder if that's the point. Is the word transient or transitory just really a word used by people that have missed it, or people that just generally don't want to understand it, or people that really wouldn't tell you if you had inflation if it hit you square in the face like it has anyway?
I think a lot of it has to do with the definition of inflation. And I've heard two different arguments. One, transitory, saying inflation's going to spike and then it's going to go right back down, which I think that's kind of ludicrous because you saw the numbers today for hospitality workers. It's pretty tough to incentivize people to come back to work and give them 18, 20, 22 bucks an hour. And then a year from now, say, just kidding, you're going back to 14 or 16. But then the other crowd that's a little bit more reasonable is like, okay, it's going to moderate after this spike. And I disagree with that as well, because when you look at the inputs that are kind of going in, it's misleading to look at it from a more conventional supply and demand curve basis, kind of the macro outlook. But if you were to look at the fundamental supply, so everybody looks at demand, and that's how we've been taught for the last 20 years to look at every equation. But the supply side has changed so dramatically with everything. And you're seeing it today with bottlenecks and everything from lumber to copper to iron, even energy starting to move, gold starting to move again, but then like other things like semiconductors, used cars, and labor. And so the nature of this, I think, is going to be far more secular than transitory, whether you look at that as temporary and mean reverting or temporary and going back to where we started.
Well, I mean, at a bare minimum, inflation is cyclical. I mean, it goes up and then it goes, in this case, it's going up a lot, and then it might go down a little bit. But the real question to me, when you're trying to define something as transitory, i.e. it's going to go away, like it came and then it went away, like it's a good example using labor. Guys, you can throw up that chart from yesterday, one of the most interesting charts of the week, the jobs hard to fill index. So when you say like short supply on labor of people willing to work at a certain wage, I mean, it's shockingly low levels of Americans that want to work, at the prevailing rate. So I think that's, again, labor is going to be reported on the latest of lagging indicators when this is all said and done. But it's almost like mathematically impossible to get to inflation that's like up and then tanking. Like, guys, slide 15, we'll just show where we have inflation going, James. I don't know if you guys have an opinion on this or if you need one, given you're so asset focused in terms of being long of certain equities express this. But going to 4 something on inflation at 4.2, now the street's expecting 4.6. Maybe that's too high for tomorrow, or I think it is for at least tomorrow. But what that chart really tells you is that inflation's going to stick north of 3.5 for the next 3 quarters. And that's, to me, that it's not just to me, it's the economic and market history. Owning inflation outright, or hard assets, or assets, asset light models that are invested in hard assets, how you express it, that's really something that killed you for like really up until a year ago.
Yeah, it's been absolutely brutal. And I basically define, you can look at base metals. So let's focus in on copper, where they've been in a secular bear market where it's been absolutely brutal going back to 2011. Same thing with gold. The last time gold was at these levels was 2011. And people forget energy. You go all the way back to 2008, where we were still double the current price. And so all 4 of these industries have been absolutely brutal for over 10 years. And In some cases, there was kind of a pre-global financial crisis boom, and then kind of a second surge in 2011, and then we come all the way through today. And I think that, and then also the fact that the indices own virtually none of these companies anymore, people just don't care, and they figure I don't need to care. But this is going to become a much bigger component of, I think, where returns are going to be generated, and people are going to have to get up to speed and understand what to own and why to own it. And we've suffered the slings and arrows with everybody else, and luckily we're enjoying kind of the bounce here.
Yeah, I mean, it's been one hell of a bounce. I mean, if you've been long, INFL instead of ARC, I mean, you got one that's sinking and one that's howling up into the right, making new highs. The CRB Commodities Index, guys, you can show that. I mean, that's a pretty good proxy for real world inflation. I mean, that hit a new cycle high yesterday. So it's not like there's any give up. But back to the point that you're making on demand versus supply. So if I go back to college and I use this, kind of bullshit linear econ thing where it's all about supply and demand, I'd ignore this thing called the U.S. dollar. The U.S. dollar has had tremendous impact going back, when you talk about the long cycle back to 2011, and when Bernanke was devaluing the dollar, twisting the curve, doing whatever it took, I guess Draghi said. What do you see today in terms of the dollar case for hard assets, or how you've defined asset light, with hard assets in your model?
I think the dollar is extremely important for certain assets like gold. Everybody's always going to trade gold, especially short term on 10-year reals. And so the dollar is going to be incredibly important there. But I think there's a very different dynamic. And the dollar is important, but it's not as important when you look at things like energy and then some of the base metals that you don't really have much of a choice. The elasticity equation is extremely different. And the point I was making on the demand side is concomitant with the fact that they've been in basically extended 10, 15-year bear markets across all these key commodity inputs. Capital markets have basically cried foul on all of these industries and withdrawn capital. I think it's most pronounced in energy, where if you look at the amount of capital that's come out of conventional exploration and energy, even before COVID, we were down 78% in North American E&P CapEx going through the beginning of 2020. If you bottom ticket through the beginning of 2020, if you bottom ticket in 2020, we were down 90. And a lot of these projects that are being curtailed or delayed or even completely canceled, these big rigs that are these big offshore platforms, they're 5, 7, 10, 12-year projects. So right. You don't flick a switch and just say, give me $3 billion and get those barrels back on. And similar dynamics in a lot of the base metals, similar dynamics also in precious metals. And that's why we think the PPIs are coming on so hot, and you're seeing kind of China trying to cool that, because that's the leading edge of inflation, and that's where you're really seeing the pressures already today.
Yeah, it's amazing to watch the U.S. yip yap on what the CPI will or will not be tomorrow. I don't care. I mean, we're talking about a May number. It's a May number. You're going to sell your inflation holdings for a May number when June we've seen, the Chinese PPI went to 9%, and they make up the number. In other words, they're understating it. It's a really interesting thing to watch. Before I get into the macro tourism of it all, can you hit again on, I think, what you're basically trying to get into, maybe in a little bit more detail, the effect of ESG on CapEx, and so many people going there without going over here. Do you think that that's something that you could actually change, or that's going to perpetuate inflation?
Oh, it's going to be one of the most wildly inflationary forces we've ever seen. And
you mean a government policy could be inflationary?
But ESG in particular, because you have this green wave worldwide. Look at what the Chinese urbanization and the Chinese development of the late 90s into the 2000s did to the commodity index. Now, magnify that times 10 and look at the entire world ripping out their existing power grid and shoving a bunch of copper and nickel and zinc and iron in there to modernize all of these projects. And I think the industry all of these industries have looked at it and saying for the last 10 years or 15 years, going back to the GFC, there's never going to be this type of a secular demand driver ever again. So we're not doing long cycle investments. We're actually going to rein it in, because we're never going to be in an aggressive growth environment again. And guess what? It takes a lot longer to get that supply back on now that you've got this enormous fiscal wave that's going to be very oriented towards these types of commodities colliding with a supply curtailment and limited supply.
Yeah, that's a. If we're going to electrify everything, we're going to need a crap load of copper. I'm pretty sure about that. And again, like to your point, it takes a long time to find it, dig it out of the ground, produce it, and then again, change kind of whatever supply demand imbalance you have. I think people have in their own heads right now when they're talking about transitory on stuff like this. To me, I guess the other big thing, the other big risk to this, one would be the dollar going up in the short term. That can always provide some disinflationary force, but not a massive one. That's not one that's really concerning me right now. Is maybe you're saying that there's a chance that the Fed doesn't do what they've been doing, like the Fed's going to taper or the Fed's going to raise interest rates. Like, what do you think the probability is of that? And I don't mean in your lifetime. I mean like in an investable lifetime. Like for me, like 2 careers from now, like a couple quarters.
Pretty low. And let's look at this more from a social analysis as opposed to a more fundamental or a more hard analysis. Their narrative has gone where they're pretty overtly stating that it's no longer the dual mandate of inflation targeting and full employment. There's now a social overlay and a societal overlay where they want to solve inequality. And the inequality equation requires far higher employment with far higher wages. And if that is pursued aggressively, and I think it's, you're kidding yourself to say that there's no political influence on the Fed anymore, so it's going to be pursued, then you're getting money into the median households. Median households spend a lot more than a billionaire putting another zero on his or her net worth. And so that given that new narrative of the Fed, and it's the same narrative going on everywhere in every OECD central bank. So I think it's extremely unlikely unless there's a step change in how these countries' politics are being run.
I mean, I can't find anyone anywhere unless they're trying to become famous in the short term at one of these irrelevant Fed regional places where somebody for real is actually saying that they're going to raise interest rates. So I do put it in the bucket where it's unlikely, but I do get a lot of pushback on that for whatever reason. The other big thing that I get is that the bond market has signaled that the peak of inflation is here, therefore. And what do you think about that, getting to a local cycle peak, which I just showed on that slide 15, guys, versus the, again, trending level of inflation that's much higher?
I think take a note from equity markets where you've got meme stocks going up 200% a day because a bunch of people in Reddit decide to kind of buy something that is worthless or close to worthless. The bond market, just because people think that bonds are more rooted in fundamentals and math than equities, there's a similar disconnect there. And I think that there's a lot of intervention from central banks in bond markets, and there's a lot of forced buyers. Who in their right mind, whether you're an institution, an individual, or a sovereign, looking at your chart right there saying 3.5 through the back half of the year is going to load up on the 10-year at 1.5. So I think there's nothing close to the price discovery that there once was in bond markets. And I think it's not all that different when you look at equity markets. It's a lot different from the historical relationships.
Well, part of that too, I'd argue, I wonder if you agree or disagree with this, and you did hit on the Reddit, the Reddit factor. The Reddit factor is the people. You can say whatever you want about them, and you can say whatever you want about me, or about you for that matter. It doesn't matter. What matters is incentives. Like, why would somebody who has negative real rates, or to your point, is going to earn X, which is 0, on their retirement accounts if they're allocating the way that their old wall broker told them to? Why are they just going to sit there and take it? Why wouldn't they be betting on everything under the sun that could be inflating tomorrow, including whatever the stock is of the day?
Yeah, and I think you just brought up a really good point that not enough people talk about is the social component of inflation. So there's a behavioral finance is what drives a lot of these prices. And it takes a long time for people to understand that they're being debased. And the seeds are being sown for inflation gradually over time. And if you go back to the last true inflationary cycle, you can go all the way back to the 60s where you had Vietnam War spending, then you had Medicare, Medicaid, then you had that little thing where they got rid of the gold standard. And then all of a sudden, 15 years later, when you've got the OPEC oil embargo and you're waiting on odd days to fill up your gas tank at 10x the price, then it's like, oh, wow, this money in my pocket is going down every day. Then you had that behavioral shift and people said, well, I'm just going to buy stuff. Mm-hmm. And I think that that's starting to occur here today as well. And that's going to be a big trend. that you don't just stop quickly.
No, you have not been able to do it. You got valuation experts as far as the eye can see saying this should, could, or wouldn't happen, but it is happening. It's happening. It's, to your point, behavioral. It's one of the most important parts of markets, and most importantly, tying this back to tomorrow's CPI report, do you think that everyone who already sees inflation is going to wake up tomorrow and believe the government if they say, hey, see, it was transitory?
Yeah, I mean that this goes into the other boogeyman, which is the composition of CPI, the hedonic adjustments, and all these other things. Where, look, I look at CPI, and I used to live in New York City. I moved out to the suburbs in the past year, and my cost of living has gone up dramatically more than what they're saying it is, and I think most Americans would say the same thing. So, I think there's also a big disconnect between how you position a portfolio for inflation and not necessarily wanting to be 100% aligned with CPI, because there's a lot of inflationary forces that are underweighted or not captured at all within that composite.
Guys, did we lose him there? We good? I'm having a bit of a problem here with my pack. Apologies for that. Something with my mic. Can you hear me, James? Sorry about that.
I can hear you.
Sorry about that. Apologies. It was my little battery pack here in my pocket. So I got you on that. So CPI, at the end of the day, a third of it is shelter, and it's a made-up number. A lot of what people should realize about the CPI number is that it's a made-up number, right? You've changed the number almost a dozen times since 1996 just to make sure that there is no real inflation. But at the end of the day, I keep saying this to people: if you don't just at all pay attention to that, the conversation, like, why do I need to pay attention to somebody talking about transitory or not when I can just own it? Just own it.
Exactly.
Just own inflation. And then you're going to believe it because it's in your account every day. Now, the problem with the people that haven't owned it or even haven't bought one of these meme stocks, if that's their way of expressing something that they may not completely understand about the CPI or whatever we want to get into on a wonkier basis, just own it. If you own it, you're going to believe in it because it keeps going up, and that's the most important thing, I think. Let's get into how you've expressed that. Can you get into how you thought about constructing the ETF? And I like how you talk about asset light versus hard assets. Maybe start with something like that.
Yeah, and I think we originally kind of came to this concept where a lot of these companies we've owned for a long time at our firm, and we were getting concerned about inflation a while ago. 5 years ago, way early. And then COVID and the policy response and a lot of the fundamental factors kind of dumped gasoline on that thesis. And so now it's even stronger than it once was. But our conclusion even 5 years ago was that given how flat the yield curve were, given the low absolute level of interest rates in the US, you really needed to go into equities to truly benefit and compound in a sustained fashion from an inflationary cycle and kind of a revision of these hard assets relative to a lot of the intangible assets and high multiple, high duration assets. And the biggest problem with that is when you go upstream, the businesses are extremely capital intensive. Mm-hmm. So think an oil and gas E&P or a gold miner or a copper miner. They spend a ton of money to earn money, meaning they have huge working capital requirements and they have a low return on assets. So they lever that up with balance sheet leverage. And so now you've got two forms of very high capital intensity. And that can work great for you if you time the cycle perfectly. But if you don't, you can lose a tremendous amount of money. And so our solution is to still get access to those inflationary end markets, but in capital light businesses. Mm-hmm. And what I mean by capital light is you still have access and you still have direct exposure or even ownership to those hard assets, but in businesses with very high operating margins, minimal working capital requirements, and little to no balance sheet leverage. And so what that lets you do is really own inflation a lot longer without getting forced out of your trade if you're early or if there's a cyclical downturn. And so this is really meant to be something you could own at any point in the cycle. It's not a binary bet on inflation, and it's meant to compound throughout the full or multiple business cycles.
Yeah, and looking at your holdings, there are, I think you'd have to admit, there are some that would be, to me at least, more one-way bets than the others. There's some that are just explicit levered bets on inflation. If I have oil going up, I have the price of copper going up, I get that leverage in the company's P&L, and I get that multiple expansion and or just that stock price appreciation versus some other things. I mean, I don't think. Do you think that that's fair to say that not every single bet is not a one-way bet?
Yeah, I think that there's varying degrees of a one-way bet, but with a royalty company, for example,
Right.
you're earning it's not uncommon to earn a gross margin of 80 or 90%. And when you're earning that type of margin and you have that type of profitability, you don't need to lever it up. So yes, the business is going to do dramatically better, and there's basically infinite operating leverage and scalability as the oil price goes up or the gold price goes up. But more importantly, you don't have that. You have an asymmetric downside because you don't have the leverage, you don't have the break-even costs that are basically incurred by all of the upstream miners. And so, yes, it's definitely a directional bet, but kind of with bumpers put on it relative to going into that more of a bet when you kind of go into the upstream names.
So can you? So you got direct bets and then you got indirect bets. I mean, that's another way to say it as well, I assume. What's a great example of an indirect beneficiary of inflation?
I think the best example are financial exchanges.
Yeah.
So the Chicago Mercantile Exchange is the largest derivatives exchange in the world.
Mm-hmm.
And their four main product lines are interest rates, currencies, soft commodities, hard commodities, and now they've even got some blockchain stuff that's really interesting. So imagine a world if we were to get sustained 4% CPI. Chances are the 10 years not going to sit here around 150. I'd have to imagine you're in the threes, if not fours. I mean, dare I say you could go positive in real terms on the 10-year at some point. And then obviously, in order for a 4% CPI, you're going to need softs and hards to go kind of much higher, and probably a lot of new things getting developed in blockchain. And at the end of the day, if you simplify what a financial exchange is, they're a supercomputer that's basically just taking a spread, or excuse me, a commission on matching buyers and sellers. So the heightened volatility, they're going to earn more and more commission across all of their product lines. And in a sense, it's actually counter-cyclical, because in that environment, I wouldn't imagine that the S&P 500 or a lot of these long duration tech names are going to be making all-time highs, whereas these exchanges in many cases are going to be printing record high cash flows.
Mm-hmm. Well, that's a very good example, and one that someone probably wouldn't have thought of unless you explained it that way. So thanks for the simple explanation. And then there's this whole, to me at least, my research team is constantly working on these SPACs because, again, it's been misconstrued by ye old wall, like, oh, it's a SPAC, therefore, it's just a vehicle by which it came public. They're companies. There are a lot of SPACs actually out there that are going to be recipients, beneficiaries directly or indirectly to inflation. Have you found yourself and your research team spending a lot of time on certain kinds of SPACs that may or may not yet be understood?
Yeah, I think there's a lot of interesting companies. And to your point, it all comes down to the alignment of the founder, the alignment. Is the warrant structure prohibitive? Is there a pipe that's coming in and getting a lot of economics ahead of you? And so a lot of the SPACs get vilified for the bad actors, but then there's also some good actors and some great businesses. And so if they come public at the right price, and one thing I get asked constantly is, oh, do you own crypto in your fund? And the easy answer is no, I don't, because we don't own any commodities directly. We would want to own it through a capital light, operating leverage, scalable business. And there's actually a company that's looking to take back public right now that actually buying that from the Intercontinental Exchange, which happens to also be in the portfolio, where that's a business that we would definitely look at, and a SPAC that we've been very attuned to at our firm. So again, short answer is yes, absolutely. We're looking at a lot of these.
Yeah, I find that, because again, SPACs seem to find themselves with what maybe old school businesses or whatever. Old school is the cool school these days. The cool school is the bad school. You again, ARK against INFL straight up. It's not even close. And for a long time, people would have rather been told a story by, not to pick on Kathy, but be told a story about the future that may or may not be true, as opposed to what I see on the tape every day, which is inflation being printed literally in the commodities market and in my commodity price sample basket, which front runs inflation daily. I don't have to guess. It's right there. And if it were to turn into a deflation call, I'd see that too. So, is that something where you're getting, incremental interest from abroad? Like, there are a lot of asset allocators out there that aren't stupid.
Yeah, a lot of, I think actually a lot of people are running that same chart where they're saying, what is kind of the biggest, highest beta, highest duration bet in the market? And how does this fund perform against them? And as you mentioned, it performs very favorably. And I think that we're in the beginning of a very long secular shift where you're going to see a lot more returns going into these more capital oriented businesses. And by definition, if there's going to be inflation and rates are going to rise, these infinite duration assets with no free cash flow for decades that at least I can identify are going to be worth a heck of a lot less money. And so at the very least, allocations like this give you a counter exposure or even a pseudo hedge if you're over levered or overexposed to a lot of these really long duration growthy type names and markets.
Yeah, in my vernacular, like if you need to be long inflation, you'd want an economic scenario that's either quad two, where it's what we have now, both real and nominal growth is accelerating, inflation's ripping, or quad three, where you get economic stagflation, which is actually a very interesting scenario, depending on what people view the future to hold in terms of all this devaluation in dollars and fiscal spending. I'm okay with both. I'd be long your fund in both. I haven't been able to backtest INFL against quad three for enough time because your fund isn't old enough, so I need the time series, but an educated guess, front running my own model, is that it would quite like stagflation. Is that something you agree with?
Yeah, look, I hope for society's benefit that we don't end up in a prolonged quad three of stagflation. But what does that mean? That means basically a lot of these commodities and a lot of these PPIs are moving without economic growth. And so this is exactly what you'd want to own. And I think to your point, a lot of the quants out there that are trying to back test things and trying to look at what happens in inflation, the only time you've really had this is in the 70s. And there's not a lot of value because a lot of the companies in this fund and in a lot of other funds weren't even public. And so I feel like if we were to have stagflation, I feel like a lot of these algo and different types of models that are whipping around in the market wouldn't even know what to do because there's just no precedent.
Well, what they do is they chase 1 month price momentum. And once that becomes 3 months, it chases that too. And that's what I do. I front run the machine. I mean, it's very straightforward in terms of conceptualizing. Implementing it, however, and staying with it, much harder. You have to have patience with an inflation cycle when a lot of people don't even know what that is. But again, like today, you look at Campbell Soup. Like, would James own Campbell Soup or would he own more of Texas Pacific land? Ding, 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 you know what to do, right? Campbell Soup has all the costs we've been talking about on the input side and on the labor side with no pricing power, and TPL's got nothing but net on the asset light model, correct?
Exactly. And that's one of the biggest points is the labor component is a lot of people when they try to think about, hey, how do I want to position for inflation? You look at one side, do they have pricing power? And there's plenty of great tech companies and plenty of great companies out there where you could make a heuristic and say, sure, these people can easily raise prices along with inflation. But there's two other factors. One is, what are you paying for the asset? So if you buy let's call it an industrial REIT trading at a 2% cap rate, and they can push on rents at 4% with CPI, you're going to get destroyed on that cap rate going up far more than you benefit from them growing revenue with inflation. Similarly, the cost side, it's not easy, but everybody has an ability to push some type of price. But the more important thing is how can you control your cost side? And a big part of cost is going to be labor, but then also it's going to be how can you reinvest your capital effectively? And in this last disinflationary cycle, a lot of these big companies that are printing record high margins have had the dual benefit of increasing margins by virtue of declining costs, namely labor, but then also being able to invest capital extremely effectively because there was a lot of opportunity to put money to work. And I think we're at an inflection point with both of those sides. So there's going to be pressures on both sides of the equation.
Yeah. The way that again, I'm obviously not giving you advice on what to do with your fund, but, there is a difference. Like when I see quad three, if and when we get quad three stagflation, which is becoming an increasingly likely outcome by the fourth quarter in America. So I've been talking to people about, okay, we're going to go from quad 2 rip-roaring fun, inflation and real growth where a certified monkey can make money on the long side, to getting a little tougher, because during the 1970s, obviously, there was huge multiple compression in a lot of different equities and P&Ls, therefore, and then there were a lot of things that started to perform differently. So would you reorder the deck chairs in terms of your portfolio weights if you had a stagflation economic scenario versus a current, what I call quad 2 inflation or rip-roaring fun inflation quad 2 portfolio?
Slightly. I think one of the great things about this fund is what really hurts people in stagflation is how do you put your money back to work? And then also the beta component of your portfolio. I mean, nobody can kind of escape the broader market beta. But the beauty of these businesses is that because they have such high gross margins and in many cases they have such long asset lives, they can kind of weather through that cycle a lot more seamlessly than companies that have a lot of working capital, a lot of leverage. But obviously, I think that the number one thing would be to look at some of the names that definitely do have more of a pro-cyclical and higher beta to the overall economic growth and market growth, and try to evaluate, is this something I'm comfortable holding through some bumps?
Yeah, I think that on an ongoing basis, which is why you have you and your research team, you're going to be evaluating that. These are live and breathing animals that are dynamic, particularly on the labor side. You don't know until it changes, and as it changes more, you change, obviously, your portfolio weightings alongside it. The other thing that I really liked about your portfolio construction, in as much as, okay, if it's quad 2 or quad 3, I'm a winner in this anyway, is how you have your max weights. Like I try to teach people that 6% is my max in anything equity. 6, that's it. It gets to 6, and if it gets above 6 because I did so well in it and it appreciates above 6, then I'm going to sell some, I'm going to prune and plant and put it somewhere else. Why do you use 6 as your peak?
I just look at it exactly. So what I want to capture is I want to capture a broad opportunity set of inflation, both on the individual company name, but then also on the sector and subsector level. Mm-hmm. And so I don't want to make this a binary bet on any one company, on any one commodity. And honestly, there's enough of a great universe where I can basically say, look, you're buying this because you want to benefit from inflation. You don't want to benefit from me overweighting my best ideas and giving you a huge concentrated fund. And honestly, some institutions have come to us and said, that's what we want, but that's not what this product is.
Well, I mean, whether it's Stevie Cohen or it's Ray Dalio, you always want the supersonic, high fee fund. So you might want to try that at some point. You just juice it, man. You go, because people love their stock picks. They're just like, they just can't shake it. I try to teach them diversification. This in particular is a great way to do it because you don't have to pretend that you have a research team or a process like you guys do to do it for them. But in terms of how many names do you have all in? Because it's not like you just have like six or 10 names.
There's 40 names in the portfolio today, and then there's another, call it 60 to 100 names that we identify as inflation beneficiaries. But we do very rigorous bottom-up fundamental research, and you'll notice some very large and prominent global exchanges, even some royalty companies in there that are not in our portfolio. And a big component of that is valuation. And so that's a big thing that I think we identify the inflationary end market where we have a positive fundamental view. We overlay the business model, which I think is one of the most important aspects and one of the biggest parts of this fund. But then you bring it all together by actually having price discipline. You're not just throwing darts at the good business models in the good end industries.
Right.
So that's, again, why we want to have this to be a little bit more diversified. But to your point, if you're of a certain amount of net worth, and this is X percentage of your portfolio, those people can afford to go, you know what, give me 10 names and I'm going to lever it up 10 times because I just want to juice this thing for all it's worth.
Yeah, I mean, it's a great answer to an important question, which is, again, there's embedded diversification, so you don't have to get one commodity bet right, which plenty of hedge funds have gone away with those, both on the long and short side, as you know. But again, a good example is Prairie Sky, which natural gas on my signal didn't break out until really the last 2 to 3 months. And then all of a sudden, wow, you got this great, Western Canadian asset that is oil and gas, I think. You can tell me if I'm right or wrong on that. that starts to do its job while, some things like some gold mining setups or whatever they may be aren't doing as good a job as when we were in quad 3, and then in quad 3 gold miners will probably lead the charge again. To me, that's the embedded rotation in your book, because not all commodities work at the same time.
Exactly. And that's the beauty of having precious metals and more pro-cyclical things like energy and copper and iron ore, is that if you were to own this through a secular inflationary shift, you're going to do great, but you're not going to have the huge drawdowns that you would if you wanted to go into those extremely pro-cyclical commodities through a CTA or into the commodity itself. And then to your point with Prairie Sky and Topaz, these companies in the Western Canadian Sedimentary Basin, where there's a huge secular shift now of Canadian companies getting gas up to Kitimat and up into the West Coast, where they're going to be exporting LNG. And that's going to be massively ESG friendly because you have a shorter shipping cost to get that into the JKM markets. And there's some of the cleanest extractors in the world. And so I think LNG is going to be a very important secular shift, and Canada's just getting started there. So yes, you're on the price signal, natural gas is great, but then also you're capturing a very early stage of a much longer and bigger trend in Canadian gas.
I mean, count the number of people that thought that natural gas could work this year on the institutional investing planet, and it's pretty damn close to zero. Okay, so that was a beauty. I mean, the other thing that I probably just said that triggered people, because they know that I'm short gold. But I'm long. I have a 6% position in your ETF. When I go to my max, which is when it's from the low end of the range, I trade it. I hope you don't mind. But so I'm long XLB, which has gold miners in it. It's not like I have no gold exposure. I have my physical gold. But gold itself, if I have a max short position of 4%, is also a hedge to that. I mean, do people, first of all, does it bother you when I say anything negative about gold? Particularly when you go out of quad 3. Again, gold loves quad 3. That's back-tested truth. It peaked in 2011 in quad 3. When we were in quad 3 stagflation into September and the early part of October, it peaked again. It's rails. I mean, it's not like I have a personal, vendetta against gold.
No, it doesn't bother me in the least. And honestly, you know better than I do what gold's going to do in the next 1 month, 3 months, 6 month, 9 month, 12 month. But I'm saying the dollar, all these things are going to go up against the dollar in the fullness of time.
Right.
And through these businesses and through this type of a strategy, you're going to benefit in a very nice fashion.
But I don't have to be, or all you that are listening, isn't it refreshing? You can evolve, having lived this life of a gold bug. I mean, give yourself and your family, your friends a break, right? I mean, you don't there's so many ways to be long inflation protection, inflation beneficiaries. You don't have to bet the house on one thing. You can have many things. And I think that, there are very few people, James, and that's why I wanted to have you on that have done such a good job right out of the chute like you guys have in constructing this. So another way of complimenting you again. But I want to take some other people's questions, if you don't mind, because I'm sure people are tired of listening to me. There's, great. First question's from Montana. Bill from Montana. With respect to real assets and inflation hedges, is it not more important what is happening with real interest rates than whether inflation is accelerating?
I think it depends on what you're paying for the asset and what the duration of the asset is. So what's happening with real rates is incredibly important. I mentioned to gold, at least over the short to intermediate term. And it's wildly important to your classic real assets, such as global listed infrastructure and commercial real estate, where again, these assets have been they're financial assets that have already been inflated by the Fed. But if you kind of shift away from these yield-oriented assets that have a much longer runway of growth, whether it's energy, whether it's copper, and some of these other companies, I think you can still really benefit from an inflationary cycle where you have less sensitivity to those real yields.
Yeah, that's another thing that obviously triggers some people or gets them thinking it should. There are very few things that backtest against gold better than real yields, and there's nothing that makes real yields fall faster than stagflation. So that's why it peaks during quad 3 stagflation, like I said, in 2011 or again last year. It's just that people, it seems, James, want to have in a beautiful, maybe it's more a boomer thing because it's Tiffany, right? Tiffany blue box, beautiful, simple rule. As long as I get real rates right, I get everything else right. It's just not the way that it works in your portfolio, does it?
Markets are a lot more complicated than that. But if you wanted to make that bet, I'm sure you could find some way to play a derivative or a steepener or any types of those ways of trading it. But again, I think that you want to have businesses that you have a strong outlook on 1, 3, 5, 7 years and weight them appropriately so that you feel comfortable with how you're going to be within these different quads within a broader, longer term secular inflationary mindset. And so that's really that's really how we've constructed this.
Yeah, that's I mean, what you find with you is that you answer questions simply, concisely, because you've thought it through. Whereas a lot of people have been sold a lot of one-liners and talking points. They flip around a lot, and I can see why they're frustrated and why they need me to empathize with them. But it's not going to change the answer, which is to do it in a diversified way, like you have, or I have, for that matter. Dave in California, this is a question about this because I'm getting pinged on this 6 ways to Sunday on this damn CPI print tomorrow. James, on that CPI print. Pending a massive miss, this is what I wrote this morning, by the way, that the number could easily miss. I mean, the street's expecting 4.6. I'm not at 4.6, as people can see on the page. Yeah, that'd be really hard for a number that the government doesn't want to have at 4.6, which they make up anyway, to be at 4.6. So pending a massive miss, this is Dave asking the question, can we really read that much into it from a longer-term inflationary outlook perspective?
Not even close, because even if there is a massive miss, the economy's not fully reopened. There's a lot of metrics that are saying we're fully reopened, but the global economy is nowhere near fully reopened. And we don't have global supply chains fully reopened yet either. And so I get a lot of questions on energy, which we have a very strong long-term view on oil, but nobody knows what the clearing price of oil is going to be until OPEC has those barrels back on the market. And we know, or we have a better idea of how much Iran is already getting onto the market and they get their barrels on the market. Mm-hmm. Same thing with CPI and same thing with inflation. There's different stages of opening, different stages of worldwide. And so I think whatever happens tomorrow, it's going to work into somebody's narrative great. It's going to work into somebody else's narrative fine. It's probably going to be horrible for somebody else's narrative. But in the greater scheme of things, it's really not important because we don't know. Both teams are not fully on the field and lined up to square off yet.
No, not even that's on a reopening basis. Let's try trending volatility of the oil market. I mean, oil volatility went from 350. That's like the VIX. The VIX being at 350, people, all right? My people, 350. And now it's at 30. It can go to 18, and oil can go a lot higher than this. And listening to Cathie Wood tell you that she didn't think it could go to 70 is useless. She's not a commodity super cycle person. By the way, on super cycle, I don't know if we have to I don't think I have to make a call on super cycle. If you want to make a call on one, the question is asking you to. All right. So here's the question, and it's a guy from Toronto. They love their commodities in Canada, as you know. It's been a long time coming. They've been in a bear market forever. Does James see how long does James see inflation going for? Like if you look back on a time series, does he see a commodity super cycle as some are calling for?
Honestly, I do. And I don't think it's going to be a blast off and then kind of just keep running away. But I think that to the extent that we're going to continue to pour money into a lot of these ESG initiatives, you have far more demand for a lot of the base metals than the world just has for supply. And supply is just not going to catch up. If you look at Ivan Glasenberg at Glencore, he's like, we need $15,000 copper before most people would even consider digging a new hole in the ground. And it's the same thing with energy. I mean, up in Canada, I mean, what would be the required IRR for somebody to do a greenfield project with a new company kind of doing a conventional oil project? I mean, it's through the roof still. And so that's why I think, and we also just don't have a way to transition off this. The solution is not there, whether it's for automobiles, for power generation, even though that's more gas oriented. We're kind of cashing in our chips before we know what we're going to buy. And I think because of that, there's going to be a very long and sustained secular shift more from the demand side for a lot of these commodities as the world figures out, okay, how are we going to power ourselves? What are we going to build things with over the next 20, 30, 40, 50 years?
Yeah, this is a question that's like very hard to answer in getting where it ends up, right? I mean for everyone. Warren Buffett bought silver in 1997 at $4, and he thought that was a hell of a deal. He was using a supply-demand imbalance, as you'll recall. And he sold it at what, 7? It went to 50. Yeah, so at the end of the day, it went to 50 under the Hunt brothers, but it went a lot higher. And when he came, and here's a guy, I think him and Munger do some pretty good bottom-up work. They use supply and demand. They didn't know where the price could actually go.
Yeah, nobody knows where the price can go because there's so many different factors that are driving the clearing price. But one of the things that I love about the non-precious metals, and obviously there's some recycling in different types of markets for copper and iron ore and things like that, but with energy in particular, once it comes out of the ground and is consumed, it's gone. You're not ripping down an old building and salvaging the steel and the copper out of that. And so if there's a period in time where a lot of people need that and there's a deficit of it, prices can get really wacky, just like the front month future got crazy in 2020.
That's what prices do. The higher you go, the faster it gets. I mean, if people don't know how that works, they actually don't know how gravity works. I mean, there's some very basic assumptions that people like Einstein taught us. The higher you go, the faster it gets. Like entropy, exponential functions. These things aren't going up on valuation. So that's maybe one of the questions I have for you that isn't in the queue is, how do you know that you're selling it at the right valuation when you own it, when you're getting it out of the portfolio?
We make an assumption about where we think kind of the marginal cost of supply and where demand is at in the underlying commodity. And then kind of what are we paying for that on an NAV basis in our portfolios? And we fully tax everything and discount between 5 and 7%, in some cases much higher than that, to really do a bottom-up NAV. And if we can still hit that underlying hurdle rate of return, given a fairly conservative assessment of the underlying commodity market, we're going to continue to hold. In some cases also, if there's a business that's just phenomenal and you have all of this open-ended upside that you can't quantify, what could the price be and what could the production levels be under scenario X that nobody thinks is possible, I'll hold that for option value because the option price is not priced in. Only kind of the knowable inputs, which are max production and price, are inputted. But something like a Franco-Nevada, the mining company, you effectively have a extremely long duration call option on the gold price, but also production, because as the price goes up, it becomes more and more economic to explore those mines deeper and laterally where break evens are higher. And so that's never fully priced into these companies, which gives me a lot more confidence that if the cycle really is moving, it allows me to kind of have confidence to hold that and kind of see how things shake out.
Yeah, that's a good process-based answer. I mean, it's really something I personally have struggled with. I mean, I'm going into the 22nd year doing this, and selling early isn't a unique experience. But it's entirely, again, using the Buffett example, so many people got excited. The guy bought like the world of silver, and they woke up one day and they're like, really? Warren really likes it. And then Warren didn't like it enough. And again, it's a really humbling thing for people to go through the investing experience, and inflation to me, while it's already been for a year now, it's been fantastic. I really wonder if so many people really know the answer to the ultimate end of the question, or if they need to. And for me, and I wonder for you, what would be the thing that you would be most concerned about if it hit? I get asked this damn question all the time, but please don't get upset or offended by it, because sometimes I do. I'm like, it's not just one thing, but are there things that you would wake up to that say, wow, that really changed in terms of the inflationary outlook?
I think a radical adjustment in how the governments are running the world, because to use David McCullough's ex-PIMCO's term, we've basically been in a 50-year cycle favoring capital over labor. And the winds have been blowing for a very long time, and we've had different regimes that have done very little for labor. But I think that we've crossed that tipping point between COVID and where society stands in virtually all, our light timers, in all of the developed world. And they're saying, we need to address this, and we need to basically re-empower labor. But if there was, let's say there was a backlash against that, we did that, it blew up budgets, there you had some sort of a situation where society was much worse off. And then governments came in and said, look, we're going to Volcker this and really fix this and reverse all this nonsense. I don't think stuff like that happens overnight, but that's something where you'd have to kind of dig your heels right in the ground and then run the other way.
Well, I think that's why tomorrow's reaction to the CPI does matter. It certainly does politically. Don't forget, Republicans are blaming Democrats on real-world cost of living rising and devaluing the dollar, which is 100% accurate, and I'm not a Republican. I'm not a Democrat either. I'm Canadian, right? But this really gets into an interesting place ahead of the midterms. When you start getting the government to lie about what's actually happening, and at the same time, on inflation, and at the same time, really fully backing with MMT labor for the first time ever, really, in the modern era, that gets to a place where it gets really interesting, much faster. And to me, that's another thing that, under Janet Yellen's watch, you think that labor's like the number one part of the question that you said, would be unwinding that. As long as she's in her seat, that's her job.
Yeah, exactly. And it would require the populace to basically say enough is enough and aggressively, change a stance. And I just don't see that happening. Things like that happen over very long periods of time. I think the populace it took a very long time for moderate Republicans and even moderate Democrats to shift more and more towards saying like, look, we need to do something for labor. And so now that's the political census almost worldwide. And I think for that to be reversed, it would require something extreme. But then again, it would take a very long time because we've had an extreme divergence in the benefit of capital versus labor for decades and decades. And there's any number of charts you can pull up, real wages, inflation index versus per capita GDP, and certainly against the stock market, it just doesn't compute.
Yeah, I mean, one of the longest standing charts that we show in every macro deck going all the way back is labor against capital. You're absolutely right. We're talking a multi-decade downward sloping labor line versus capital getting paid, and that social contract has obviously changed. So if you're betting against inflation, you got to be betting against labor, and I don't think that that's a very good bet. And I don't think you and I came up with any other way to get to any other answer. So thanks for that, man, because it's such a well-rounded way to talk about inflation, and I think so few people do it. That's why I wanted to have the conversation. So thanks again for making the time, and congrats on building what you guys are building over there.
Yeah, thanks so much. It's been a great discussion, and appreciate your support and look forward to coming back again.
Anytime, man. Anytime you want to do that. Hopefully we have them back every time we're supposed to have a bad jobs report or a bad inflation report, because we're going to buy the damn dip in those until we don't. Thanks for joining us.